Good afternoon and welcome back to our ACA webinar series. This is session 4, Testing Your ACA Knowledge. My name is Casey Hope. I'm the Director of Marketing and Communications here at Medcom Benefit Solutions, and we thank you very much for joining us today. So we're going to do a little something different, and we'll explain more as we get started, but just to let you know, all of these webinars and presentations are always packed with useful information. So we are recording this presentation and we will be able to provide you with that recording and the slide deck after we conclude today. We will also have a Q&A session at the end of the webinar. So if anything that we discussed today, if you have questions about it, feel free to go ahead at that time and put them in the questions panel of your GoToWebinar control panel, and we will address those at the very end. So today I am joined, as always, by the incomparable Michelle Barki, our Senior Legal Counsel and Director of Compliance and HIPAA Departments here at Medcom Benefit Solutions, and ACA Sales Team Member Extraordinaire, Tom Neal. So welcome, Michelle, welcome, Tom, and welcome to each of you. We're going to go ahead and kick this off. Michelle, do you want to give everybody a little rundown of what we're going to be doing today?
Yes, Casey, thank you, and thank you for that introduction. Today we thought what we would do is there's still some confusion about some of the finer points of the ACA, despite the fact that we've been at it for 6 years. So what we thought we would do today is test your knowledge. And Casey has set up some poll questions, and then we'll see how we all do. Today we're going to be spending most of our time talking about applicable large employers and what do we do if somebody is just at that threshold and how that all works. So we thought we would have a little bit of fun with this today. And so let's go ahead and get going. And again, you know, we get a lot of questions and there's still a lot of confusion out there. So I thought I would take a definition of confusion. And it's the state of being bewildered or unclear in one's mind about something. So let's find out if we still have some of those unknowns about the ACA. So the first question is, your client comes to you in 2021. They've just come to you. And for the first time ever this year, they will average more than 50 FTEs, including FTE equivalent employees. And they're asking you about the ACA and what they must do because this year they're going over that threshold. So how do you respond?
All right, so your clients reach more than 50 FTEs in 2021. How are you going to respond? We've got option 1. You are an ALE, an applicable large employer in 2021, and you're going to have to report to the IRS. Let's get you set up with a vendor. Apologies for that typo there in that option. Or option 2, you are not an applicable large employer in 2021, and we will not have to report in 2022 for the year 2021. So here are our options. Getting some poll answers in right now, so thanks to those who are voting. So once again, a review. Your client comes to you in October of 2021 and says that for the first time, they're going to average over 50 FTEs. What is your advice in this situation? All right, just a couple more seconds to get those votes in. Thank you so much. All right, Michelle, here is the response. We've got 48% of attendees say that the employer is an ALE in 2021 and they must report, and 52%, slightly more here, say that they're not an ALE in 2021 and will not have to report. So, Michelle, what say you?
Thank you so much for that, Casey. And again, you know, a state of confusion because we are equally divided. But they are not an ALE employee in 2021 because to determine if you are an ALE in 21, you look at the year before. So in 2021, when they first hit that magical 50 mark, they are not an ALE. They will be in 2022. And in 2022, they will need to report, but that will only happen in the year 2023. Just like with regular taxes, you report the next year on what you had this year. So here's our second question. Your client is opening a brand new business and they're really excited in 2021. And it's going to be a combination of a restaurant and a pool hall, and they'll have 3 locations with 1 tax ID. And the client is hiring at least 50 full-time employees for the grand opening on July 15. What is your advice?
All right, Michelle, here's our second scenario. Michelle's lined it up for you. So here are your options for this new client with the pool hall / restaurant, 3 locations, 1 tax ID. So what is your advice? Do you, 1, because you expect to have 50 full-time employees in July, you're going to be an ALE in 2021, so we need to set you up with insurance and a reporting vendor to file for 2021. Or is it option 2? You will not be an ALE until at least 2022, maybe even 2023. So we don't have to worry about that. So we're going to go ahead and let these answers come in just for a little bit of a review. This new client is opening a new business. It will have 3 locations with 1 tax ID number. So what is your advice? Do they go ahead and set up with insurance and find a reporting vendor, or do they have a little bit more time? Option 1 or option 2? All right, let's go ahead and close this one out. Michelle, so 44% say that you must report the full-time employees for 2021 as an ALE in 2022, but 56%, also a very close margin here, will not say that will not be an ALE until at least 2022, maybe even 2023.
And Casey, you know, that's another state of confusion. The answer is you would have to report in 2021 because you would become an applicable large employer in 2021. Why? Because the IRS wanted to confuse us with the regulations, and they said the only exception, or one of the only exceptions to the previous year rule, when we look at the previous year and determine whether or not you were an applicable large employer, is if you were opening a brand new business, and if you were opening a brand new business with a reasonable expectation of having 50 full-time employees, then you are an applicable large employer when you open, and you must get insurance, and you must find a vendor to do your reporting or do your reporting the next year. So that was a kind of a tricky question. Okay, the third one, the third scenario. A business owner has 3 companies with different tax IDs. Each have 20 full-time employees and no part-time employees. It has been this way since 2018. The companies have never offered insurance because they only have 20 employees. How do you advise?
All right, Michelle, so we have 2 options here as well. So as their broker, as their guide here in the ACA water, so would you advise that they may still be an applicable large employer and must consult the payroll records to make sure? Or would you advise that companies with fewer than 20 FTEs are not applicable large employers, and so they shouldn't have to worry? So a review here, we've got a business owner with multiple companies and tax IDs, but with only 20 FTEs per business, but they haven't offered insurance since 2018. How would you advise? Could they possibly still be an ALE? Or because they have fewer than 50 and they only have 20 FTEs, they shouldn't have to worry about it? So thank you so much for getting those answers in. We have a closer margin, or a more distinct margin, I should say here. We've got 78 people say that they may still be an applicable large employer and they must consult the payroll records. And then we've got 22% say that companies with fewer than FTEs are not ALEs, so they don't have to worry. Michelle, what say you?
Well, 78% of the people got it right. We have the aggregate rules. If you are a commonly held company with common ownership, you have to aggregate all the employees for each of those 3 companies to determine if you're an applicable large employer. And then you divorce again, but each of those companies are an applicable large employer and must report, even if they only have 20 employees. So when you've got 3 that were in common ownership and they have 60 employees, between all of them, then all of those companies with 20 each are applicable large employers and must report. And if it goes back to 2018 and they haven't reported, and they had 60 employees in 2017 amongst all of them, then they got to get all those back filings done. Now here's another one. A panicked new client comes to you on December the 23rd. Their accountant has just run the numbers, and the company has averaged in 2021 on December the 23rd, they've averaged 50 full-time employees, including 50 full-time equivalents. So they're going to be an ALE come January the 1st because you go by the previous year. So in December, they figured out that they're going to be an applicable large employer in 2022, and they're panicking because now they've got to get the insurance in place and everything else. So you appreciate their new business and you want to work hard to get their insurance before January so they won't be penalized pretty hard over Christmas. So you tell them that you'll do your best, but they should have come to you sooner. But what is the advice you should give them?
All right, Michelle, thank you. So here's our scenario. You help a new client get insurance in a rush. You advise that they should have come to you earlier, and that you're not sure, basically, if you're going to be able to make this happen because of the holidays, because of that break that's coming up, and a limited time frame. So was this the best advice? Yes, they have to be in a hurry. Yes, you have to do this ASAP. Or no, do they have more time? Is it a little bit more flexible? Or is it maybe a little bit of both? So different scenario here with your answers, yes, no, or maybe. So is this the best advice for that client who just realized that they're going to cross that 50 full-time employee threshold? All right, we've got our responses in. Michelle, we've got 26% that say, yes, this was the best advice. You have to rush them. We have to get this done quickly. We've got 16% that say no, maybe they've got a little bit more time. 58%, an overwhelming majority here, says maybe this was good advice. So, Michelle, what do you think?
I think that the no's have it. You do not have to panic. When they come to you on December the 23rd and they are absolutely panicking because January 1st they're going to be an applicable large employer, the IRS is not completely heartless. And basically what they say is as long as you have insurance in place, if it's your first time becoming an applicable large employer and you have the insurance in place the first or the fourth month, you're good to go. So that would be, you would have until April to get them in place. However, it has to be in place in April, and all those employees who were full-time last year or continue to be full-time would have to be offered coverage on April the 1st. They couldn't go through another waiting period. So take a look at it this way. You know, you can get a waiting period going and it would be 90 days or 91 days, or you could just say, hey, you know what, we have until April. Let's enjoy Christmas or the holidays and then come back in January and we'll get your business in place. So don't panic. But if it's not in place by April, they're going to face penalties. And the penalties will go back till January, by the way. So it has to be done by April, but you don't have to panic on December 23. Go home and enjoy yourself. Now, the next scenario is an employer comes to you with an ESRP letter for 2017. And an ESRP letter is an employer shared responsibility penalty letter. They got a love note from the IRS, and the company failed to offer coverage in 2017, and yet they were an applicable large employer. And as you know, you have to offer coverage to your full-time employees. So they come up with a brilliant scheme, and they say, look, let's go back and do measurement periods in 2016 to see who our full-time employees were in 2017, and perhaps we can get rid of some of these individuals and by putting them in measurement periods. And can you do this and save them some money on this ESRP letter?
All right, so our final scenario here, an employer has reached out because they have that ESRP letter from 2017. So they put 2016 staff in a measurement period to lower the penalty amount. Will this work? Yes or no? Shorter question here, more simplified responses. So as we're getting those poll questions in, I want to say thanks once again for participating in this interactive webinar. I hope you've gotten not only some new knowledge, but also just entertainment out of it today. So certainly thank you for that. We're going to go ahead and close this poll out. Michelle, 36% say yes, this can happen, but 64% say no, it can't. So what do you say?
The no's have it. The IRS has made it clear that when you do a measurement period or a waiting period, it's considered a limited non-assessment period, which means you won't get penalized for the periods that people are in this limited non-assessment period. But it only applies if the employee is offered health coverage by the first day of the first month following the end of the period, and only if the health coverage offered provides minimum value. So if you didn't provide coverage at all, chances are one of these two things did not occur. So typically what we do at that stage of the game, we can't use a limited non-assessment period. We would have to go month by month and figure out who worked 130 hours in that month. And that's where the penalties would be based. So maybe 1 month the employee would be you'd be penalized on an employee. Maybe the next month he went under the average. But again, limited non-assessment periods only apply if you offer coverage the first of the month following the end of the period, or and if the coverage offered is minimum value. So even if you didn't offer a minimum value plan and it was a skinny plan, you can't use these non-assessment periods. So that's something to be very, very aware of. And with that, I'm going to turn it over to my colleague, Tom Neal, an extraordinary sales representative for the ACA. Tom.
Thank you, Michelle. Also, I am beaming over here as one of your pupils because I actually got all the questions right. I was a little nervous about that. So I have been listening. You can go ahead and make note of that. And Casey, thank you for all your help. What I kind of want to do, and especially after hearing everything that Michelle gave us and seeing the answers, it was pretty clear that we're kind of on many of these subjects right down the middle. And I mean, and we are the professionals in this industry and we are confused on ACA. Can you imagine what these employers are like? And so obviously, the best thing to do here is we always say the best defense is a great offense, and that is to get a vendor and a solution in place that takes care of your clients. So these kind of tough questions are answered the right way, and they are covered as under the ACA Act. We certainly can do that. We have a whole range of ACA products, including our reporting, our FTE tracking for those seasonal hour employees, penalty appeal support, where we've gone over 50 million in proposed penalties we've been able to mitigate, backfiling, which not a lot of vendors do. We certainly can handle that, especially if you've got a client that you just meet with and find out they haven't been filing and should have. That is certainly something we can help with. And then we can also do consulting and strategic evaluations, kind of coaching for those clients that need that type of mentoring help. But again, the most important thing is what's behind it. There are a lot of options in the market, and it's the expertise behind them where Medcom shines. I mean, with Michelle making sure our teams are sharp, she even makes me an expert. So definitely a way to go to make sure your clients are taken care of. And again, just to kind of go over the ACA reporting service itself, we would first and foremost assign an account manager who is an expert that will handle the heavy lifting for them from beginning to end, including setting up a strategic planning meeting so that we listen to your employer, because everyone's different, and make sure that we have all of the special items that would pertain to them covered. Data management, as I've said many times, we're easy. We'll take that data as long as it's in a live format, any way they can get it to us. We have a team in place of data technicians who are happy to slice and dice and put that in a format so that we can use it. Again, that's included in the service. We have our proprietary system to do an analysis of that data, but more importantly, live experts are going to look at that data and make sure it makes sense, make sure we have what we need, because it's all about the data. They will do the validation, they will do the coding, both the safe harbors and each code for the 1095C. We'll get you a model notice, which is a simple 1095C that's blank, but explains what each box is, and that's great to send to employees, especially those that have never gotten a 1095 before. Will definitely alleviate a lot of their questions. We're going to do an external validation. We're going to make sure that your employer sees what we've done with those 1095s. We're going to give them to them in a PDF format. We're going to give them a cheat sheet so that they know what we did, what our thought process is, and why we picked the codes we did. Because at the end of the day, just like Michelle said earlier, this is just like filing taxes. Whether a CPA does it or yourself, the company is still responsible for doing the reporting. So we want you to understand what we're doing, agree to it, and give us that go. Once that's done, we will then print and mail those forms to all the employees, everyone that should get one, making sure if anything gets pushed back, bad address, return to sender, we will work with you to make sure that is done correctly. Once that's complete, we will then e-file those 1095Cs and the 1094C transmittal to the IRS using their proprietary AIR system. We're familiar with that system. We know how to handle it. We know if any pushbacks come, we will handle those and make sure everything is filed correctly. At that point, we will keep that receipt and the reports we've done for you, and we will keep those in case you're audited. Your employer will always have a ready place to get that information. And again, all those items are included in our reporting service. And now also don't forget that Medcom is an expert in several different fields in compliance administration. We want to make sure it's not just a product we offer you, but we offer people behind those products that know how to get this done and know how to get it done correctly. We have our CDHP and COBRA teams, premium billing administration. We have HIPAA privacy and security solutions, health and welfare compliance and actuarial solutions. And I will even mention, especially on the compliance side, can't believe it's already June, but July is the biggest month for 5500s, both renewals and new. So if you have clients need that, please reach out. You're more than welcome to reach out to me, and I will make sure to get you to our compliance experts. In fact, they wanted me to make sure you know if you have a group or block that you want to talk about, we certainly offer volume discounts, and we'd be happy to put those in place for you. So again, overall, Medcom is here to make sure that we offer you the weapons you need to have that cutting edge in the industry. You've got the experts behind you to make sure your clients are taken care of. And so now I'm going to hand it back over to Casey so that we can answer your questions. Casey?
Awesome. Thank you so much, Tom. Thank you so much, Michelle. I really enjoy doing these types of webinars. They're a lot of fun. And we do have a few questions here. Michelle, we kind of have a scenario back to us. A small business has been in operation for a few years, but they get big funding and open a new location with over 50 FTEs. Are they in ALE the next calendar year or as of the date they start with the new location?
You know, if they opened up a new location and they opened up the new location with the 50, you know, that is a really, really good question. I don't think it's been answered before by the IRS. I think you could argue it either way. I think you could say, hey, for the new location, let me ask, if it's with the same EIN and they just opened up a new location, definitely you would not be an ALE until the following year. If they were an acquired business and the acquiring company had 50 and then they acquired this company, the acquiring company already was an ALE, so they're absorbing you, so you would be an ALE at that time. But if you were just opening up a new division with a separate EIN and you had 50, I think you could also go to the next year. So the only way I would think that the IRS would get you is if you were bought by a company that was already an ALE, then you would be an ALE that year. But I think you could argue that you just had a change. But it's an interesting question. I'd have to think about that EIN though, if you open up a brand new EIN with 50. and then you have this company over there. I'd have to think about that one, but that's an excellent scenario.
Yes, it is. Thank you, Michelle, for taking a shot at that one. Will the IRS waive 2021 ACA penalties due to COVID-19?
There is no indication that they're going to waive 2021 penalties due to COVID. If you had a reason why you couldn't get the filings done on time in 2021, and because your people are off and you're not there, and your payroll department's not there, potentially we could use that as a reasonable cause determination if you were late in filing. But they won't waive the penalties as far as I can see for ESRP, no. But again, we always have to wait and see what the IRS does.
True, you never know at times. So the hospitality business has also, in relation to COVID-19, has been like a yo-yo in terms of staffing. So what would you suggest in the way of organizing a strategic plan or a planning session for all of the hospitality clients and ACA reporting?
So I guess the question is, would we do potentially another webinar just for the hospitality individuals and put together a strategy for how they would determine if they were applicable large employers, and then how we would manage the full-time employee situation with them going up and down like yo-yos. Mm-hmm. And now I understand there's a lot of hospitalities that are having difficulties in hiring people as well. So I think that would make an excellent webinar, and we'll consider doing one like that for the hospitality and for anyone else that has variable hours employees.
Absolutely.
I'm not sure that answers the question, but we can certainly talk about that.
Yeah, I do think it's something that all of us are going to have to reevaluate, especially when it comes to the pandemic and how much our job outlook has changed over the past year. Tom, do brokers and employers really need the full service solution that you mentioned earlier? I mean, is it pretty much everything automated at this point?
That's a great question. Actually, and you have to kind of be careful of that. There's a lot of vendors out there that have some very fancy websites, some really excellent data manipulation tools. But as I briefly mentioned when I was talking about the products earlier, the real key is the expertise behind it. Is making sure that it's not just a fancy website, but that there are people who truly understand the ACA, how it pertains to a particular business, and knows how to make sure that business is covered so that they aren't facing any possibility of penalties. Full service is exactly what it seems. And our idea here is that many businesses, they're busy running their businesses, just like our brokers are busy running their brokerages. So the thing is to let us be the experts. This is what we focus on. And if we can take this off their hands, they have more time to run their business. So that's why we believe this is the best solution for this type of service.
And Tom, if I may add to it, because I do a lot of the employee shared responsibility penalties, it also comes down to sometimes garbage in and garbage out, where the employers really aren't sure what to put in some boxes. So for an example, payroll companies might talk to them about, well, what's your measurement period, or what's this or what's that, and put this here and put that there. And the employers have no idea what they're talking about, so they just fill out anything. And then at the end of the day, when they get their ACA 1095Cs to review, they have no idea what they're reviewing, and they just approve it. And then 2 years later, all of a sudden, you see the garbage. Yep. What we've seen is, did you offer coverage to 95% of your full-time employees, including the dependents? And they have no in so many of those boxes. So, what was the monthly, what did the employee have to pay for the lowest cost plan for single coverage only? And they put in the full value, the full amount of the premium, so that now you've got an affordability issue. And then on the back end, you're trying to clean up all this mess, and you see it over and over and over. So as what Medcom does is we walk you through the situation, and if something doesn't look right, we're going to let you know up front.
Great answer, Michelle. Absolutely. And in fact, just to kind of fill that out, that's also why we are right now in the height of signing up new clients and renewing our current client base. And that's because we want to start this now so that you're not waiting till the end of the year for a data sheet to print out, so that you can make sure that things like affordability of the insurance offering, make sure it's right now so that you don't get to the end of the year and have an ugly surprise, or as Michelle said, 2 years from now and you get that love letter from the IRS. So it's about having experts in place to handle it so you're not worrying about it.
Thank you for that, Tom and Michelle. And kind of on the same line, when we're talking about affordability, an ALE, here's a different scenario for you. An ALE sets the working requirement for their self-insured health plan at 40 hours per week and pays 55% of the premium. All employees work at least 40 hours per week and elect coverage. What are the penalties, if any, the employer may be exposed to here?
Sorry, Casey, can you read that one again?
Yeah, absolutely. So it's about, I think, affordability, and I think some of the, we might need more information as far as pay rate and things like that goes, but we have an ALE that sets their working requirement for self-insured health plan at 40 hours per week and pays 55% of the healthcare coverage premium. All employees work that 40 hours at least and elect the coverage. Is there a potential penalty here for the employer?
In that scenario, I'm going to say no. And the reason I'm saying no is because all the employees elected the coverage. So they won't go to the marketplace, and they certainly wouldn't be entitled to a subsidy. If some of those employees did not elect the coverage, then there might be an affordability issue. If you're using the rate of pay method, it's still based on 30 hours a week, not 40 hours a week. And depending on the W-2 method, it might be the best method to use at that point. But technically, you're supposed to offer coverage at 30 hours a week. So I'm glad you don't have any employees that are not 40 hours a week, because you've offered coverage to all your full-time employees regardless of the amount. But the biggest issue you'd run into is affordability if somebody did not take the coverage. But if every employee took the coverage and you offered coverage to the dependents, then you shouldn't run into any penalties.
Thanks for that, Michelle. And just kind of wrapping things up here, we know, and it's something that the three of us spoke about before this call today, we know that June, the Supreme Court is addressing some open issues here. What are the chances of the Supreme Court throwing out ACA requirements?
Aha! I was wondering if somebody would ask about the Texas case, because we are coming up to the end. You know, if the Supreme Court was to say that the ACA was unconstitutional, they would probably, as they did in the past, give a bit of time in order to see whether Congress can amend it to make it affordable. The reason that it's unconstitutional. The reason that it's unconstitutional in this latest scheme is because President Trump, under the Tax Cut and Jobs Act, reduced the penalty for the individual mandate to 0. Thus, it's no longer a tax, because you can't have a tax at 0. So that's where the constitutionality is, and then whether the whole scheme would fall. So the only thing that President Biden would have to do is say, you know what, I am now instituting a tax on the individual mandate once again. It will no longer be reduced to 0, and that would make the whole case go away. And I think he's going down that road anyways.
So it's another one of those we'll have to wait and see. Thank you for that, though, Michelle. Thank you, Tom.
Yeah, but what I would say, Casey, is I wouldn't bet on the ACA going away this year.
All right, and so that's it. You have it here. That's our best guess here at Medcom Benefit Solutions. And thank you so much for attending today. Thank you for participating in our interactive webinar. Thank you so much, Michelle and Tom, for sharing your expertise. And we will be back here in 2 weeks with testing your knowledge part 2. So we're going to have additional little scenarios for us to walk through and see how much each of us know. And Tom, I wasn't as good as you. I didn't score 100% on this quiz. So I'm going to have to do some studying before the next 2 weeks is here. Thank you all so much. We'll be sending out a recording of this as well as the slide deck as soon as possible. We hope you had a wonderful holiday weekend in celebration of Memorial Day, and hope you have a wonderful week ahead of you. Thank you so much.